Our today topic is about money supply process. We know that normally any change in money supply is happening through the central bank in every country. There are three main players in the money supply process. Of course, the most important player is the central bank. After that is the banking or financial institution, and the third player is depositors. So today we want to know more about money supply process. It means that if the central bank is performing any monetary policy, easy or tight monetary policy, how it is going to affect the balance sheet of the central bank. So talking about the balance sheet, we have to explain about the two components of the balance sheet, which are the liability and the assets, which is the two compulsory component of every balance sheet. Talking about the liabilities of the central bank are categorized into two parts. The first is the currency in circulation, and the second is reserve. Currency in circulation is the note that we are holding, and it's the exchange medium of exchange for us. So we can buy the products with the notes and coins that we are holding. These are the currency in circulation, and do remember that it is the liability of the central bank. Why it is liability? Because of the simple reason that once you are holding a note, if you refer to the central bank and you ask to exchange for the note, the central bank has the obligation to change this note for you. For example, if you are holding $100 and you want to change it, you want to make it into a smaller piece like having $250, or you want to have even smaller parts like $20, is the responsibility or liability of the central bank to do that for you. Apart from the currency in circulation, we have another type of the liability, which is the reserve. Reserve are two parts. The reserve means that a kind of the deposit which is deposited at the central bank, or the physical deposits that the banking system are holding. So it means that, in other words, we can divide the reserve itself into two parts: the required reserve and the excess reserve. Required reserve are the amounts that has been dictated by the central bank to the banking system, that they have to keep a particular percentage of the deposit that they are receiving from the depositors. So it means that, for example, normally this percentage, we assume that it is 10%. It can be higher or it can be lower based on the policies of the central bank. So if the bank is receiving 100 units of deposit, 10% of that deposit has to be as a required reserve, which is obligated by the central bank. It has to be in the central bank account. And we know that all the banking system, they have an account with central bank. Out of the remaining deposit, which is the excess reserve, is going to be the asset for the banking system, because this excess reserve is the reserve that enables the banking system to create loan out of it. So do remember that the reserves are the liability of the central bank, but they're going to be the asset of the banking system. So now that we are done with the liability side of the central bank, we move to asset side. So what are the assets of the central bank? Of course, the first asset is the securities. If you remember open market operation from your previous modules, you know that one of the main tools through which central bank is performing the monetary policy are the securities. So it means that they are buying or selling the securities. These securities are considered the asset for central bank. Apart from this, the central bank sometimes they have the responsibility to providing the reserve to the banking system. And that's why we call that the central bank is giving loans to the financial institution. These loans sometimes are called borrowed reserve. So it means that it's a kind of reserve that the banking system has borrowed from central bank. And of course, anytime that the central bank wishes, they have to return this borrowed money to the central bank. So that's why this is considered the asset for the central bank. The rate at which the central bank is giving this loan to the banking system is called discount rate. So this is called the borrowed reserve, and it is the rate at which they provide this reserve is discount rate. One more point is that liability of the central bank, which are currency plus reserve, are called high-powered money, or we call them monetary base, MB. So monetary base or high-powered money are the liability side of the central bank. Then we remember that we say that through this reserve are the amount that can be both deposited at the central bank and can be held by the banking system. So any change in this side, in the liability side of the monetary of the central bank, is going to affect the monetary base or money supply. So that's why if you want to know that whether the money supply in the society is going to decrease or increase, you should know that whether the currency in circulation is changing or the reserve is changing. Now let's do some examples that we're going to understand better. For example, we want to start from different policies of the central bank, and we want to know that how these policies are going to affect the T account of the banking system and the T account of the central bank. The first example is saying that the Fed is performing an open market purchase. How it is performing, we say that we know that open market purchase, it means that Fed is buying the security from the banking system. So it means that once it is buying the security from the banking system, means that it is giving the reserve to the banking system. So that's why we expect that the money supply is increasing, and that's why it is easy monetary policy. And then from the bank, and then it pays a check to the banking system. This check is actually the amount of the reserve that the central bank is providing to the banking system. And the banking system deposits the check into the Fed account. So now we want to know that what is happening to the Fed T account. So we know that one side is the liability and the other side is asset. And since we have to do this for the banking system, I try to write it in a way that later on I can do for the banking system. So this side are liabilities, and here are assets, and the same is here. And then assets. Okay. So here we know that the central bank has bought 100 million of bonds. So bonds are type of security, am I right? So if there are security, we know that the security or the asset part of the central bank. So that's why we write here securities. Are the securities are increasing? Yes, they are increasing. How much? They are increasing 100 units. So it is positive 100. So what is happening then after the security is increasing? So it means that they are giving some reserve to the banking system. And if you remember, we were saying that the reserves are the liability of the Fed, and there are the asset for the banking system. So here the reserves are increasing. So how much are they increasing? Of course, with the amount of the purchase, which is 100. It is again positive. And this reserve is also positive 100 here. So if I ask you that, is money supply in the society is increasing or not, what is the answer? The answer is yes, because here we discussed that the money supply or high-powered money is C plus R. Since the reserve here has increased, so it means that monetary base or money supply in the society is increasing by 100 units. One more point before we proceed is that the liability side of the central bank here is called M1. So you remember that previously we have discussed about M1. M1 in this language, in the language of the T accounts of the central bank, is the liability side of the Federal Reserve account. And the asset side is M2. So whatever the components of this side is the asset side. So overall, how much the securities has increased? The security, it has increased 100 units in the Federal Reserve account. Then how about the securities of the banking system? The banking system, they have sold the security to the central bank. So that's why the securities here are minus 100. Has the amount of the security changed in the society? Of course not. The security from banking system has been transferred to the Federal Reserve, but the amount of the security is remaining the same. How about the reserve? We can see that the amount of the reserve has increased. So that's why the monetary base is increasing.